good. It's like some recognizes faces. Gil, first time getting to meet you, man. So looking. Good. And then I recently just got back. If you guys didn't hear, me and my wife went to Japan for our 15-year anniversary. But we have got Andrea here with doing taxes and CPA stuff. Andrea and I have been working together for how long now? Long time. It's been a while. It has to be because it's when you started. Yeah. And then Ryan. Yeah. That's actually how Ashley got hired by us.
I didn't know that.
Yeah. So Ashley works for Full Circle Investment Group. She's been with me since for the past 5 years, and done amazing. She owns her own real estate. She started her own company, and then she still does all this with Full Circle and Hopportunity. So, so super impressed with what she has done and become. And she's done a lot for us at Hopportunity, as well as Vanessa that helps us in the background. Yep. She does audio and marketing, and Alex, and JP. So Coleman. Ryan's been working with you guys for at least more than a year now. And we've put these guys through the ringer, right? We do all the crazy ass files and I need it done yesterday, all the stuff, right? And these guys never falter. They always take care of it. They make it happen. And I can say that it's been an awesome time working with you guys. So I really appreciate you coming tonight and talking. Talk to help these guys out. And then Andrea's going to talk to you guys about the CPA stuff. And if I can tell you anything, she will keep your ass in check, right? For those guys listening and those guys that are here, this is a person that has helped me, Sean, you're fucking up. What are you doing? Let's get this straight, right? And that is something that you need as part of your team to have that check, right? You're good with certain things and you need to hire other team members that are good with other things. So don't think you can do it all because you damn sure can, right? And then she's going to be that person if you ever hire to, just kick you in the ass and be like, we need this, need it done now. That's how it is, right? So that's going to be a good talk. So I think what I wanted to do was I was going to have Ryan kind of do, because I think yours is probably a little bit shorter than Andrea's. And I think you can talk first. And then we would get into Andrea's stuff. But real quick, JP talking to who he is and what he does, because he is now our second hand, or he's right up there with me, and he took the place of Alex.
Yeah, took the place of Alex. Alex and Sean started over 5 years ago now. And I jumped into this obviously to learn, and I'm still in it to learn because that's what it's all about. And network, of course, because these guys have been able to bring in folks like them on an array of different topics. So it's just been a big benefit to anyone who's, been able to make it. It's evolved a ton, obviously with COVID coming around, they were able to adapt and went online, so can have a broader reach. But local agent, I work with Alex Winfield's team. And just trying to help fill the shoes and here to connect with you guys and learn more as we go. So
awesome
resource for you guys.
All right, let's get right into it. Ryan kicks it off and you do your part, and then we'll have Andrea do hers.
We'll leave lots of time for Q&A.
Cool.
Investing. Okay, cool. All right. So my firm does primarily settlements. Okay, so transactions. So we get the buyer and the seller. We just get everything across the finish line. Okay, we do all kinds of fun stuff. Obviously, working with Sean, we do subject twos, which are basically a unofficial assumption, or I guess unauthorized assumption. Subject threes are really good too. Subject four is my favorite. That's a real estate joke. You guys didn't know what I was talking about. Yeah. I made that joke earlier today to a guy on the phone, and I could just tell. The guy on the phone was just like, "What are you talking about?" Thank you, appreciate it. I do it for you. Do it for you. So there's a lot of pitfalls in that area, and we're here obviously to help you to get it across the finish line, to resolve any issues, make sure the contracts are legit. And if getting into short-term rentals, I think we're going to start talking about that in a minute. What I always tell people is when you have investment properties, and a lot of people come to us and they just buy these properties in like their individual name, and they keep it in their name, and they sell it in their name. And I always tell people, hey, you got to create an LLC, or you got to create something. Okay, having in your name, it's not a good idea. All right. Liability-wise, I mean, it leaves you liable, leaves your personal assets liable. Okay, and it's not really that hard to create an LLC. It's not that difficult. It's really easy to buy real estate and to title it into your name of your LLC. Okay, we can do that. You can do it yourself if you want. It's easy to create a company. Also, we can help you with that if you need us to help you with that. But it really leaves you in a difficult spot if something were to happen. Okay, because if something were to happen on that property and it's in your name, guess what? They can go after. They can go after you. They can go after your personal house. They can go after any assets you have, bank accounts, etc. So you always want to make sure that you're putting it into an LLC. Okay. But you also have to make sure you treat that LLC as a separate entity, even though you might be the only member, and it might essentially just be you. Okay, it has to be separate. Otherwise, it doesn't really count. So separate bank account, separate tax return, everything needs to be divided. Okay. And then you can talk to her about all that fun stuff with the accounting side of things. But make sure you're putting it into these companies. What I always tell people too is, oftentimes you're getting a loan, unless you get like a hard money lender or something. If you're going to like a bank or something, they're probably not going to give you a loan to an LLC. Yeah. If the only asset is the house that you are buying. Yeah. Yeah. So, yeah. So that's the case, then find your individual name and you can transfer it over after that. Okay. We do that often. Okay. So.
How much do you guys charge roughly to set up an LLC?
$595. And that includes the operating agreement, includes the filing fee. We can serve as a registered agent if you need us to. Registered agent has to be either someone a member of the company, okay, or a Virginia licensed attorney. All right. So some people don't want it, they want more anonymity. So they're like, you do that. But in Chris, obviously you can always pop in if you come, anything you think you'll need to add. But yeah, so $595, that'll get you covered, and it's just register with the state, and you're good. Every year, you just pay the fee.
The magic happens with the operating agreement, though. I'm not an attorney, so I'm not going to get too far into that. But the LLC is no good if you don't have an operating agreement and you don't operate according to the operating agreement. I'm not even an attorney, and I can pierce the corporate veil on 90% of the operating agreements because they all came from a company that starts with L and ends in Eagle Zoom. And they're all like the laws of the state of California when we're all in Virginia. So the operating agreement is where the magic happens. And as your tax pro, I'll be asking you for a copy of that. And if you don't have one, we're going to be having a conversation, and I'm going to send you over to Ryan, and then you can come back to me to get some taxes.
Yes, that's true. So you need to have an operating agreement. Operating agreement is basically just you're setting the terms of your company. How does your company operate? Who's the members? How can they buy and sell real estate? Like, what are the restrictions of the powers, et cetera? So many people come to us and they have property or they want to buy property in LLC or sell it. I need your operating agreement because, as she said, I need to see who has authority to sign on behalf of the company. Okay, we need to read that. We need to evaluate it. If you don't have one, then we can always make one for you. Okay, but again, you need that. It's essential. Otherwise, yeah, you need.
You have to have an EIN.
Yep.
Those are just two of the main documents you have to have.
Yeah.
So this is that moment where I tell people, don't chance on trying to be cheap. Right? Just do it. Suck it up and do it.
Yeah, and she was saying piercing the corporate veil. So that essentially. Sorry.
One of you that has a mic repeat the question.
You butt muted.
What I was saying was, this is not a moment for those guys online. This is not a moment to chintz. This is not a moment to be cheap, right? This is the moment where everybody's like, "Ooh, I can save $100 here." That $100 you're going to save today is the $2,000 you're going to pay later when Andrea's buddy comes and pierces your corporate veil and sues you, right? Like it's not worth doing.
We
So,
call that penny wise and pound foolish.
yes. This is that moment where you pay, even if you don't have it, you figure out how to pay it and find it. Set up your LLC correctly, have your paperwork, set up your bank accounts right, and do it correctly. If I could go back and smack my younger self, that'd be the first thing I would do, is do that. Because I was the Legal Zoom guy. I was the Rocket Lawyer online guy. I was like, I do all this shit myself.
My example was not by accident.
So piercing the corporate veil, you guys understand what that means? Basically, they're saying your company's not legit. So we're going to bypass that and go after your personal assets if there's, any sort of liability. So that's why you have to have an operating agreement, treat it separately. You have to do a separate bank account, separate tax return. If you have a tenant, okay, that lease needs to be in the name of the company. So initially you might have got the tenant and done a lease with your individual name when the property was in your name. You just got to do an assignment. So you just assign the lease over to your company. Okay, so again, that's not very complicated. Yeah. Yeah.
So the question was, is it worth doing a lease assignment if you only have one property?
You mean lease assignment or put it in an LLC?
Ah.
Absolutely. I mean, if it's like a rental or, if it's your own personal property, it's not as necessary, but yeah, definitely, man. Definitely. And, I always tell people it makes things more complicated, but every rental, every real estate you have, in perfect world, you want a separate LLC. Yeah. So, but again, that makes things more common. It's more of a cost, but like Sean was saying, it's upfront cost, but it protects you. It can save you who knows how much money. Yeah. So much money, so much headache. So that's obviously very important and, recommend everyone. Do you have any other thoughts on that?
I just want to add that if you put your rental property into an LLC, if it's a multi-member LLC, so it's you and your spouse, you and your brother, you and your sister, you and your mother, whoever, it's more than one person, then you're going to be taxed as a partnership, which changes the compliance picture and the compliance cost a lot. So just be aware that if you're putting properties in LLCs, you have to make sure you understand what kind of LLC you've set up, because there will be repercussions depending on whether it's single member or multi-member. And Virginia is not a community property state. We're a separate property state. So even if it's a husband and wife, it's still a partnership with a partnership tax return and all the complexities around partnership tax filings. And that jacks the price way up. So make sure you're talking to your attorney about what kind of LLC to set up. Make sure they understand. I talk to a lot of husbands and wives. They come to me after they've done it, and I ask, like, why did you do this? It's a plumbing company. Why put the wife on it? Or you own one rental property. Why are you both on it? Well, if something happens to me, I want it to pass to my spouse. There may be ways to accomplish that without making it a multi-member LLC. So make sure that you're speaking with your attorney so they understand your motives and that you're getting the right outcome. Otherwise, it's going to cost you.
Absolutely. Yeah.
So I want to throw some questions at you because I think it's relevant for maybe if you guys don't have any yet, maybe I can help answer them. What are some of the things that new investors need to bring to you when they want to close either a wholesale transaction, a fix and flip with a lender? What are some of the things that they need to be ready to bring to you to know that they're going to be able to do that transaction?
Yeah, you mean at the initial stage? Obviously, the contract. Okay, contact information. All that stuff's very important. We go through it. We'll review it. We'll make sure the paralegal will review it. She'll make sure everything's in there. Any questions, obviously, we'll reach out to y'all. If there's going to be, all of these contracts might be as is and might have some sort of particular conditions. So we'll review that, make sure that all that's being taken care of. If it's a company, as we said earlier, you're going to need an operating agreement provided to us. We're going to need to know if it's an assignment. We do a lot of these where Sean will come with assignments. Y'all familiar with assignments? So he's just basically selling the rights to purchase or sale the contract to somebody else. So we'll need to have all that information lined up. Okay. And things change. If things change, you got to keep us in the loop, addendums, et cetera. Let us know what's going on. But yeah, we need to be fully abreast of everything that's going on in the transaction. So things change. We got to know. Otherwise, we don't know. We can't do our job properly. So please keep us in the loop. Okay.
So let's talk about one that we deal a lot with his probate files and what's expected because random people sign documents and don't have
Yep.
any rights to do it.
Yep.
Can you speak to that for a second on
Yeah. Probate.
executors and administrators and
Right.
that kind of
Probate, that always gets tricky, right? So there's testate succession in Virginia, and there's intestate succession. Testate means the person that passed has a will, okay? And the will typically will dictate where their assets go. So we look on the will and we say, okay, this person had real estate, and real estate's going to, Jim, their son, or whatever. Or we can look and see if there's an executor listed in the will that says this person has the power to sell my property, to sell my real estate. Okay, that person, the will needs to be probated. Okay, before we can do anything. But probate basically means the executor goes to court, goes to the clerk's office, and just gets it recorded. Okay, nothing really special. It's a pretty simple process. And that makes everything pretty simple. If there's no will, it's called intestate. Intestate basically means the state determines who gets your assets. Okay, so if you have kids, then usually or you go to your surviving spouse, and it can go to your children, and it depends if your children are the same children of your surviving spouse. It gets pretty complicated, but we basically have to go to the law and determine, okay, who's going to receive this property, who has the power to sell this property. Once that's determined, that person needs to go to probate. That person needs to record a list of heirs, okay, and two disinterested party affidavits. Okay, so list of heirs basically says, my mom died. This is, these are our 3 children, and then she has no other children. Her husband predeceased her, etc. Disinterested party affidavits is somebody that's not an heir, okay, but it's familiar with the family, that basically vouches for what the list of heirs says.
How's it going, guys? Come on in, grab a seat. Grab a chair and come on in.
Yeah. So it can be very complicated, but as Sean was getting at, sometimes someone signs a contract that wasn't any of those people, okay, or they wasn't done properly. The probate stuff that wasn't recorded properly. So if that's the case, usually we can clean up on the back end. We kind of instruct them what to do, and then we can do an addendum, just having the proper person sign who can sell the property. So, but that happens very often in these types of deals because you get someone's mom passed and I just want to sell their property. So, to get it, somebody like Sean, a wholesaler or someone, and it gets to us, and then we got to play that cleanup game. But
Long story short, do yourself a favor, get you a will.
Yeah.
They're not that expensive. Don't let the state or whatever agency determine where your stuff goes.
Sure.
Some more questions. So if let's say that a file starts, what money is it to be expected to come to you for title, EMD? Can you talk about some of that for what your expectations are?
Yeah, well, obviously the contract will dictate EMD, who's getting it, how much, etc. We can make it easy. You can pay on our website, or the client can. In terms of costs, obviously there's a bunch of costs. Buying and selling real estate isn't cheap. Okay, everyone's going to wants their piece, but it's all necessary. We have standard title costs, running title. Okay, it's going to be probably a couple hundred, and it depends on the property, depends on how complicated the title search could be. All right, and then we're going to have title insurance. You all familiar with title insurance? Okay, so that's going to be dependent on the sale of the property. The consideration that's being given. Okay, so that's going to fluctuate over time, but those are kind of the big costs for our settlement fee. We have our settlement fee, which is $5.95. That's a pretty flat fee. Our firm, we don't charge hourly for these transactions. We charge what we charge, and it's a flat fee for, Sean texting me 500 times Monday morning, or, I'm just an unusual circumstance, not getting anything from him. So that's how we operate.
So let's say that the file doesn't close. What's the expectation on title payment? None?
None.
Okay.
Yeah.
So that's a very uncommon thing I want you guys to know, right? That is not common. If you go to any other title or attorney company, your minimum probably like $350. Well, I'm saying it's not expected to have somebody like Ryan's company not tell you you're expected to pay something, right? So don't take it for granted to work with these guys and just start putting files together, because they will stop it, right? Like that's not going to happen. But I wanted you to speak to that to a second, because I think it's awesome if something goes awry that you don't owe something, but then don't think about later on when you get an extra charge on there and you're like, hey, what's this extra $250, $300 for? Well, you had 3 other files that didn't close, man. We got to pay somebody, right? I just want you guys to keep that in mind because that's something that I think that's awesome you guys do.
Yeah, and title search is going to get complicated. I mean, we've had plenty of files with Sean where, you know, just there's like 30 heirs. Well, I don't know. One file we had, maybe it wasn't 30, but it was something.
It was a lot.
A lot of people had died. A lot of people, you know, we didn't know where they died or where they lived. And situations like that pop up. And you could take, you know, months, 6 months, 12 months to wrap these things up.
Unknown children pop out of wills, out of wedlock.
Two mystery children.
Yeah, that was a good one.
Or you have heirs that, you know, there's a married couple and this person's listed as an heir. It's like, well, they weren't really the biological son of, you know, the mom.
Your mom was a freak.
So someone's got to sign a papers basically saying that parents were cheating on each other during their marriage. I mean, it gets
or a
weird.
brother in jail.
Yeah.
We've dealt with quite a few of those. So, okay. What questions do you guys have? I feel like you touched on a lot. So do you guys have some questions for, I know you guys just joined us, but do you guys know who these guys are? Yeah. Okay, cool. Andrea is our CPA. So she's dealing with taxes and stuff like that. So she's going to be talking to that kind of stuff. This is just an open forum talk, right? These guys are here talking about what they do and why. These are people that we work with in our business daily that help us function. Andrea's been with me forever, about the same time Ashley for a long time. And the past 2 or 3 years, Ryan's been with us. So that's why we brought these guys in. That's what Hopportunity does. If we bring people in that are doing business with us in the industry here, they're here to give you those services and answer questions. Okay?
So, title search. If deal goes bad, we've done all this research for the title, you don't charge them?
Most cases, yes. Sometimes if we know it's going to be particularly complicated, okay, we'll reach out to the client and say, hey, this is going to cost us X. Okay, but most normal files.
That is impressive.
Right?
Yeah.
Well, I mean, I've had multiple deals fall through.
Yeah.
And, you know,
Some long files.
I feel for the title research.
Yeah.
You know, because they put in hours worth of work.
Yeah.
Multiple hours, you know, researching things, and then they need to get there.
And that's why I wanted to bring it up because it's they're not going to let that ball roll but so far, right? But most companies in this town are like, nah, man, you're in. We did title, we paid them, you're paying us plus our markup. Yeah. So that's why I bring that up, and I wanted him to speak to it because it's impressive. When it first happened, because we were closing a deal, and I was like, all right, well, we're in for at least $350, and we're like, went back to Ryan. He's like, nah, man, it's good. Just bring me another file. I'm like, oh shit, here we go. Right? Yeah. And it's more than just that, but I just want you guys to understand that's just one small piece of Ryan and his company and how they operate, and it's a really good piece. Oh, prelim title search? Yeah. Yeah. That's a good one too, just to kind of see what might be on title before you start digging in and put a bunch of time in. What were you going to say?
Yeah.
Where are you located?
Our main office is near Landhaven Mall, Virginia Beach. We have an office in Newport News.
And then you do personal and business taxes?
I have a question for you because I've been asked this before, and I'm not an attorney. So when people come to me and ask me questions about should I set up an LLC, I don't answer those. I can tell you the tax side of that, and we'll get into the sexy tax talk in a minute. So let's say I have a rental property in another state. Where would I form the LLC, here or there?
The other state would be optimal. Yeah.
I do have a rental in another state that is not in an LLC. Don't hit me. Don't hit me. We'll talk later.
Okay, so any other questions for Ryan? And guys, this is for anything. I mean, we have thrown some zinger files at these guys, right? And I mean, like you said, the one file had a bunch of errors on it. It's just a lot, right? And these guys really stand up to the test of time because our files aren't easy. If you're going after estates and probates and stuff like that, you've got, like we said, a lot of things going on. And I think even our easiest files still aren't easiest, right? Not like your typical buy and sell, it's done and done. Even some of the wholesale transactions can get pretty tricky. From double closings, that's something that you guys do a lot at your firm. Does anybody know what a double close is? Know what that means? Yes. Double close says that it's an A to B and B to C transaction, right? So wholesaler contracts up with the seller, says they're the buyer. They actually close on that transaction. It records down at the courthouse via electronic recording, and then they turn right back around the following day and do another closing from B to C, right? And there's money associated with that, right? There's closing costs, there's holding costs, there's probably a lending cost that somebody pays to fund your deal, but they are very familiar with that. We've done that multiple times, right? Anything you want to talk
One thing about that though is you have to have the money,
Yes.
because we can't disperse the money to you to turn around and pay for the new property.
Yep. And we will come in for that as well. We can transactional lend, right? We'll charge you a fee for it, 2-3% on the transaction funding. But take that out of your wholesale fee. If you're making $15,000 and you're paying us $3,000, you're still walking away with a pretty chunk of change, right? So can you get the deal done is the next question. They're familiar with doing that. I would not suggest going to attorneys that don't know how to do that, right? That's a tricky transaction, right?
Yeah, especially with these assumptions. There's a lot of extra documents we have to prepare, and it can be really tricky if you don't really know what,
What would you say it was? Sub 3 and sub 4?
Sub 3, sub 4, yeah.
I want to keep going on that one. That was,
Sub 5.
I like it. That was funny.
Yeah, you could go to any number, really.
Right. All right. So anything else for Ryan? Anybody online asking any questions? Got anybody listening? It's so weird not to have the, yeah. Okay, cool. All right. So let's get in and talk about some sexy tax stuff.
I'm pretty sure I'm the only speaker that ever has said sexy and taxes in the same sentence. So I planned to talk about short-term rentals because when I deal with real estate investors on the tax side, that's the number one question I get is, do I need to invest in short-term rentals? We do tax projections for our clients, and our higher net worth people are always asking about short-term rentals. So whenever I come to a situation like this, I like to kind of gauge the audience, since I don't know you guys. How many of you have long-term rentals in your portfolio? And how many of you have short-term rentals? How many of you are interested but don't know which one you should buy? You don't know the tax differences between the two. They're very different. And there's a whole bunch of tax code reasons why. My next tattoo is going to include the little tax code section symbol. It's going to be great. It's also going to say it depends, because every tax question is answered with it depends. So now I just wear a shirt so I don't have to say it all the time. I just point. So I figured I could get all technical with you guys. I'll try not to get technical, but I'm going to start with a disclaimer. This has not been tested by my attorney, so don't judge the verbiage. But basically, the information, I know. Everything I'm telling you is accurate as of today. Tax law changes all the freaking time. It could be different tomorrow. So everything I'm going to tell you is accurate as I know it to be today. It's up to you to do your due diligence, yada, yada, yada. Real quick recap about me. I founded Pro Tax and Accounting 10 years ago. This month is actually our 10th anniversary. Thank you. 4 months ago, I acquired another accounting firm called Steadfast Bookkeeping. So we're in the process of rebranding to Steadfast Bookkeeping. I am a CPA licensed in Virginia, MBA, Master in Accountancy. My team is now 11 people across 5 states. That acquisition really catapulted us to a whole new level of stress as a business owner. If I could walk that back about 10 times a day, I think to myself, I would do that. We have clients all over the US. We've got clients overseas because we work with a lot of military people. We focus on small business owners, real estate investors. We don't do a whole lot of, we really don't do any more, just once a year. We have 2 W-2s and a couple of kids, 1040s. TurboTax is a great product for that. We can't really offer any value there, so we really don't do too much of that anymore. But if you own real estate, you're interested in owning real estate, you want to plan to own real estate, you're going to be our jam. And so everyone says you need to get into the short-term rental game, but nobody can probably tell you why unless you're talking to a tax person. So just a real quick recap on long-term rentals. They are passive. Unless you're a real estate professional, which if you have a full-time job that's not in real estate, you are not going to qualify as a real estate professional. I don't care what the tax guru on TikTok told you. They lie. They're looking for clicks. So long-term rentals are going to be passive. That means that if it generates losses, which most rental properties do, and let me be clear, they can cash flow and still generate a tax loss. Depreciation is usually the thing that makes it a loss. If you are not a real estate professional and you have long-term rentals, those losses are passive, which means they're not going to help you on your tax returns unless you have other passive income. There are some other rules. If your income is under 150,000, you can take up to $25,000 in losses, but just have in your head, long-term rentals are passive. Passive losses are only deductible if you have other passive income. Yes. If you're a real estate professional, then we get to consider your losses non-passive, and they get to offset your 1099 from your real estate agent activities or your other. It's good, right? If you're a real estate professional, you got all kinds of things available to you. If you're not a real estate professional, then long-term losses are passive. You don't lose them. They carry forward until a year when you have passive income or you sell the property, and then it unlocks all those losses. So it's not a total loss. It's just not going to help you this year. That's why as a long-term strategy, long-term rentals can be effective. But as a short-term strategy, they're not going to help you this year on your taxes. So there's a bunch of code section, and go ahead.
What is considered a real estate professional?
So yeah, so what is, how do you qualify as a real estate professional? This applies to long-term rentals because the rules for short-term rentals are different, which is why there's such an attractive tax strategy. So let's keep this framed with long-term rentals. Basically, you have to spend at least 750 hours and at least half of your time, which means if you have a full-time W-2 job that is not real estate, you're probably not spending half that on real estate in addition to your W-2 income. There are a whole bunch of tests, but the main ones are the 750-hour rule and more than half your time spent in real estate. Do you have anything that you want to add to that? Because there are other tests, but those are the two main ones.
No, that's more.
Okay.
For speed.
A calendar year. Yeah. Every calendar year, you would have to requalify as a real estate professional. So you could be one year and then not the next year. So it's a year-by-year test. So it's a stringent test. If you're not like a real estate agent, that's a no-brainer, right? If that's your full-time gig, you sell real estate, no-brainer. And I can provide some resources to Sean and Ashley that they can share out for how you can qualify as a real estate professional. But long story short, if you're not a real estate agent, it's going to be a little bit harder for you to do that. Working.
So we're talking about hours. That's 62 and a half hours a month. Break it down.
Which if you have one long-term rental, you're probably not spending 62 and a half hours on it. If you are, that was a really bad investment. Maybe you want to think about a new gig. Maybe not invest in real estate anymore because it's not your jam.
For example, like for me, I work for an investment, a real estate investment, but I'm not an agent. So like that is.
That still doesn't count because you don't own at least, I think it's 5% of the company. So if you work for a company that does real estate type transactions, if you're not an owner in that company, you're just a W-2 employee, not just, but you're a W-2 employee, that's not going to help you. That's not going to count. So they make the rules, right? Like the deck is, yeah, the deck is kind of stacked against you if you have long-term rentals. And it's code section 469, right? I'm going to probably get that. For real estate agents? Yeah, because you're 1099, you're not a W-2 employee, so you are the owner of your company. So you're in. Okay, so long-term rentals, passive, can't help you this year, will help you when you sell. That's the gist of it. There's a whole bunch of, I mentioned if you earn less than $150,000, so if you have less than 150K on your tax return, some of the losses could be deductible. It phases out once you hit certain dollar amounts. There's a lot of blah, blah, blah in there. I can share this out. Now we're going to talk about short-term rentals because this is like the sexy part of the tax talk that I promised. Rentals that are not really rentals is how we talk about short-term rentals. Long-term rentals, code section 469. Short-term rentals, and that's an average stay of less than 7 days, right? There's a whole bunch of criteria. Average period of customer use, less than 7 days. Average period of customer use, less than 30 days, and significant personal services. Think like a hotel. You're cleaning while the person's still there. You're offering laundry. You're cooking meals. You're taking them out on tours. Think like a true bed and breakfast. Those are rental activities that are not passive rental activities. They're not subject to code section 469, which means they're not subject to passive activity rules. That's why short-term rentals, super sexy. We talked about significant personal services. So for short-term rentals to not be considered passive, you have to meet some tests, but those tests are easier than they are for long-term rentals. You have to participate in the activity for more than 500 hours a year. That one's hard if you only have one short-term rental. I have a short-term rental in Gulf Shores, Alabama. I don't spend 500 hours a year. If I did, it would be a bad investment and I would get in a different game. Your participation is substantially all of the participation during the year. This is a big one. So if you have a short-term rental and you don't have a property manager, you're probably going to meet that test. So your participation, the things that you do for that rental, make up substantially all of the things that are done for that rental. Fairly easy test. The second one that's easier to meet is your participation is more than 100 hours a year, and this is a calendar year, and more than anyone else's hours, including non-owners. So that means you have to add up the hours for the cleaners, for the maintenance person, this is why having a property manager can sometimes knock you out of the running for this one, because property manager is probably doing more than you are if you have one. Like my rental is 13 hours away. My property manager is spending more time on it than I am. I get there twice a year if I'm lucky. So the two main ones that most taxpayers, if they're going to qualify for, will be they provide substantially all of the participation or more than 100 hours and more than any other person. You're going to have to keep a time log. Don't come to me telling me you spent 101 hours and you can't back it up. Because if you get audited, the IRS is going to require a time log, and the IRS requires contemporaneous time log, which means you didn't throw it together at the end of the year when you got your audit notice. It means you've been keeping that log throughout the year. And if I'm going to be taking losses on your tax return, I'm going to need that log in my records to back it up.
If someone gets audited and they were doing some shady stuff, like, you know, they said they had more than 100 hours, but they didn't give the tax return. But you as their accountant said, yeah, they did more than 100 hours. Can you get in trouble?
I can get in trouble. Now, I'm not going to pay the tax you owe because that's your bad.
You're not signing. I mean,
Yeah.
They're the one that ultimately signs that this is true.
So here's how it works as a tax professional. I am not required to audit the records provided to me by my client. If you hand me a log that I can see, has probably been prepared throughout the year, so that criteria is met, I'm not required to go through and make you prove to me that you drove to Home Depot on February 17th, right? I'm not going to audit that record. You are ultimately the one signing your tax return, whether you reviewed it or not, whether your tax professional reviewed it with you or not, whether you understand it or not. You're the one signing your tax return, so you're the one responsible, not me. Now, I can get in trouble as a CPA. There are rules I have to follow that non-credentialed preparers don't have to follow. I have ethical requirements that can send me up to the board and get my license suspended or revoked. So my criteria as a CPA is actually higher than if you went to Mo Money, who only charged you $150 because they're not credentialed and there's no one to report them to if they mess you up. Yeah. That was an actual, y'all might remember, it was in the news a while back. So I have ethical requirements, licensure requirements that I am required to abide by, or you can turn me into the Board of Accountancy and I get in a whole world of trouble. So I don't take that responsibility lightly. I don't cheat on my own taxes. I'm not going to cheat on yours. So those two tests are the big ones. And as your tax professional, I'm going to ask for that time log. If you're working with a tax professional who doesn't ask for your time log, you might want to walk away. And maybe run away. That's up to you. I'm not a good runner, so I'm probably going to walk, but I would recommend that you leave and meet with somebody who specializes in real estate investors, because we're going to keep you out of trouble. And I hate to use the threat of audit. The IRS is woefully undermanned. I don't care what you heard about 80,000 armed agents coming to get you. That's not how that works. And the risk of audit is relatively low, but my bar is not, do I think they're going to get audited or not? That's not the bar that I have to worry about meeting. I have requirements and code sections with fancy numbers and letters and stuff that I have to meet, and I'm going to make sure you meet them too, so that we don't both meet at the auditor's office or jail. I'm not going to jail for anybody. It's not my color. It's not my color. I'm very ruddy complected. Orange is not good for me. So some strategies to achieve material participation on short-term rentals. And I think out of the entire slideshow, and I got a little crazy, so there's a lot of slides. We're not going to get through all of them. This is probably the one you want to screenshot. This is where the magic happens. This is where the tax magic happens. This is the sexy one. So don't hire a property manager. Now, this area is not super short-term rental friendly. Some of those restrictions are easing up, but it's not real great for that. But don't hire a property manager. If you manage it yourself, you're probably going to meet that second or third criteria from the top section. You can apply the first one, meaning don't hire a property manager, to the first year. So let's say you buy a short-term rental in August. Don't hire a property manager for that first year. Just suck it up, buttercup, do the work, communicate, set up the Airbnb, travel to clean it yourself, whatever you got to do. Don't hire a property manager for the first year, and then you can have all the benefits of short-term rentals and cost segregations and bonus depreciation, and then go ahead and let it turn to passive the next year. So do it the first calendar year, then hire the property manager the second year. You can do the repairs and the rehab yourself. I will not be taking advantage of that bullet point because I don't know how to fix things. I have YouTube, but I still don't know how to fix things. And then you can do a grouping election. So let's say you have 3 short-term rentals. You're not going to be able to meet the 100 hours of participation individually, but maybe between the 3 of them you do. And so on your tax return, we can do a grouping election to treat all 3 of those as one activity. And then it makes it easier to meet those rules. Any questions on that slide? This is usually the one where people are like,
So all this is just these strategies are so that you can make your short-term rentals be not passive income, but active.
not active, make them non-passive.
Non.
Yeah, I mean, look, I'm not, I was about to make an attorney joke.
And you're telling me if you're a licensed real estate agent, you're pretty much just
Set.
okay. So just if I could just say, you could just get your real estate license and not have to worry about the shredder control.
You could, if that's a thing you want to do and you're going to be good at it and you can make money at it.
Well,
But
here's the thing: what if you get your license and you don't sell the damn thing while you're around? You don't do anything; you just keep your license.
you still have hours to meet you still have to do that 750 hour rule and the more than half your time. So just having the license, the question was, if you just get your real estate license but don't actually do anything with it, does that make you a real estate professional? And the answer is no, of course not. That would be like crazy. I would get my real estate license. You have to actually be, yeah. No, you have to spend at least 750 hours doing real estate agent things, which can preclude you from having another full-time W-2 job, right? Full-time is 2,080 hours. If you have to meet 750 hours and more than half your time, that means you're spending over 1,000 hours beyond your 2,080 hour a year full-time job. Most people aren't working that hard. It's not impossible, but it's improbable. So the reason this is exciting, the reason this material participation is such a powerful strategy is if you can meet those rules, and they're way easier than they are for long-term rentals, then the net loss, which these are going to generate losses, the loss can be treated as non-passive, which means it can offset your other W-2 income, other 1099 income. Your losses aren't locked by passive activity rules. So let's take that one step further. Let's say that first year, you didn't hire a property manager, you buy your short-term rental, you met the material participation rules, and you only have to meet one of 3, not all 3. You get to pick one. You get to pick the best, right? Like, it's great. It's like, what is it, best ball? Whatever that golf term is, you get to do that. Then you do a cost segregation study. Who here has heard of cost seg? Do you know what that does? Okay. I'm going to give you the big picture. This is like the moment. If it's non-passive and you do a cost seg study, you could take a bunch of accelerated depreciation. So in that first year you own that rental property, instead of having to depreciate everything over 39 years, because by the way, short-term rentals depreciate over 39 years, not 27 and a half. If you do a cost seg study, you break down the components of the house. So instead of saying $200,000 bought me a house, you're going to say $200,000 bought me a $100,000 house, $5,000 in appliances, $3,000 in flooring. It's going to break it down into all the components. And then you can take accelerated depreciation on all the things that aren't the house. What does that mean? If it was passive, you're just going to have a big, huge loss you can't take advantage of. But if you meet material participation rules, you can have a $60,000 depreciation deduction all this year. So you had $100,000 in W-2 income. You just got a $60,000 depreciation deduction that you're actually going to be able to use this year because it's non-passive, that means you're writing off $60,000 of your W-2 income that's not going to be subject to income tax. That's sexy, right? Like, that's what I'm talking about. So that's why this is such a powerful strategy. I mean, depreciation recapture is like a thing that we're going to have to talk about. Yes. Unless you do a 1031 exchange, which you can't 1031 a personal residence. Who's heard of a 1031 exchange? It's a like-kind exchange. Everyone's heard of that, right? Short-term rentals and like-kind exchanges. You can't like-kind exchange your truck. You used to be able to, pre-Tax Cuts and Jobs Act, but now you can't. You can't like-kind exchange your personal residence. There's a Section 121 exclusion for that. You can like-kind exchange from one investment property into another investment property. And what that does is it takes that gain on the sale, including all that depreciation recapture, and it kicks the can down the road. You're going to roll that gain forward to your next property, and then you're going to do another 1031, and you're going to roll that to the next property, and eventually you're going to die, and your heirs are going to get a step up in basis, and nobody ever pays tax on any of those gains. Yes. This is how the rich get richer. Unless tax law changes. Let me go back to my, What happens with real estate? I own my short-term rental in Gulf Shores. I kick the bucket. My husband and I die in a plane crash. I don't know, because the Steadfast bookkeeping jet had a problem taking off, and we crashed and burned. My house passes to my kids because I have a will, and my will says that all my assets pass to my kids. What happens is, let's say I paid $100,000 for it. I paid $300,000 for it, and I've taken, $100,000 in depreciation over the years. Basis is $200,000. The fair market value, as of the day I died, right? They had an appraisal like, oh yeah, mom left us some cool stuff. Get an appraisal, it's worth $500,000. Ordinarily, if you sold it, you would pay gain on the difference between the $500,000 you sell it for and your adjusted basis of $200,000. But because I died, my kids get a step up in basis to that $500,000 fair market value. They turn around the next day and sell it for $500,000. There's right as of the date of death, and then of course they're going to sell it immediately. It's fair market value 500. They're going to get 500 for it in the market because that's what fair market value is. There's no gain to report. Nobody pays taxes.
Question about 1031. You have to. What's the time frame in order to sell and to buy the new property?
Yeah. So there's a lot of rules around 1031 exchanges. You have to use a qualified intermediary. Super important. You never get to have control of the money. If that money hits your bank account, it's a failed 1031. You just blew the whole strategy. Have to have a qualified intermediary. You would ask me the hard questions, Ryan. Do you know the dates off the top of your head? There's like
45.
It's a 45 days. So it's 45 days to identify the replacement property, and then it's like 120 days to close, 180. Yeah. I don't memorize those things. I can look up. So you have 45 days to identify a replacement property, and then you have 180 days to close on that property. If you don't meet those rules or you touch the money doesn't go to that qualified intermediary, the 1031 is blown.
Real quick, I think it's last call right now, so if you want to bring, now at the time, you've got about 30 more minutes here to ask questions.
15 minutes that we'll shut it down. That way we got a little Q&A and hang out. That works.
It's 8:30, so.
Shut it down the next 15 minutes.
Okay. Yep.
And also talking about the intermediary and the 1031. I don't know if you guys heard of Trig, Tidewater Real Estate Investment Group. I've been on that board for almost a year. We have a lady that's part of that association. Her name is Ted, and she's from Alabama.
Dope.
Starting over, if you have ever heard of Trig, Tidewater Real Estate Investment Group, there's a lady there named Ute that is what she specializes in. She's with content. She can help you make sure you don't touch the money, make sure you buy by the rules, the identification, all that stuff. She's very versed in it. If you need that information, just hit us up online and make sure you get it.
Yeah, you were still muted for that, so.
So if you've heard of Trig, Tidewater Real Estate Investors Group, there is a lady there. What is her name again? What they said. Ute with Town Bank. Not Wu-Tang. I said Ute. She can help you make sure you don't blow your 1031. So make sure that you reach out to somebody who is qualified to do that. Very, very, very important. And also I want to point out, in a 1031, It is possible that there can be a taxable component if there's boot. We're not going to do a whole tax class, but essentially, if the property you're buying is worth way more than the property you're giving up, you could have boot, and there could be a taxable component, but it's still a super powerful strategy. So part of tax planning is looking at where your income is now, where you think it's going to go, look at your goals now, where your goals are going to be, and then layering these different strategies together. Short-term rental by itself is great. 1031 exchange by itself is great. You start piling these things together. Long-term rentals are great with 1031s. Like, you're going to want to be looking at all of that. So when you're looking for a tax professional, make sure that you're talking to somebody who is familiar with real estate related transactions, because not all tax preparers are created equally. Not all CPAs, this is a fun fact a lot of people don't realize, not all CPAs specialize in tax. There are 4 4-hour exams to become a CPA. Less than 20% of one exam was even about tax. So out of 16 hours of testing, 1 hour of that testing roughly was tax related. When you become a CPA, when you go to school for accounting, there are typically 2 tracks. You go audit or you go tax. There's not usually commingling. There's not a whole lot of cross training. So don't assume because they have CPA after their name, they know what they're talking about, because a lot of times they don't. I've corrected a lot of tax returns prepared by CPAs who did not know what the heck they were doing. And real estate is kind of a unique area of the tax code. Not everybody's familiar. We all can do the research, but that doesn't mean we understand it. That doesn't mean we apply it correctly. So when you're interviewing tax professionals, and I encourage you to meet with several of them, if you're interested in real estate, make sure you're asking questions specifically about real estate. Look for the terminology they're using. You know the terminology. They should know the lingo too. If they don't, that's a pretty good indicator that they don't work with real estate investors. So don't be afraid to ask them the hard questions, because you will end up, as an example, the company that I acquired, I was reviewing a tax return from 2022 that the previous tax manager, who is no longer with us for good reason, prepared. It was short-term rentals. She reported them on a Schedule C. Short-term rentals don't go on Schedule C. And when you put it on a Schedule C, that subjects that income to self-employment tax. You don't want to pay self-employment tax on your rental income. That's not where they belong. That was a pretty big mistake that somebody who knew real estate would immediately know was wrong. And I see it all the time. So should be a simple thing, and it's just not. So make sure that you're dealing with somebody who understands real estate. It doesn't have to be me. There's lots of us out there, but make sure you're asking the tough questions.
And I have a question, if you could repeat it after I say it.
Sure.
Can we talk about how taking the losses that you've discussed can affect your buying power as it lowers your income? So although you're looking for losses, it looks good, but can also be a negative.
Yeah, so the question was talking about how losses can affect your buying power on future deals, right? Because losses reduce your income. This puts your tax professional in a tricky position, because I can't knowingly sign an inaccurate tax return. So I have people who come to me, who have literally come to me and said, I don't want to claim all these losses. I don't want to claim all these expenses. I need to show income so I can get this mortgage, and then we're going to amend the return to claim the losses. Bro, that's mortgage fraud. I'm not doing it. I admire that you had the stones to literally tell me to my face that that was your plan, but now we're not going to be able to work together. And if I had found out after the fact, I'd be even more mad. So thank you for being upfront and saving me all that work, because I would not be able to prepare that amendment. So it is a balance, right? You need to show income so you can qualify for loans. You want to have losses for tax purposes because you don't want to pay taxes. So you need to think about what's your priority. Do you want to pay less in taxes, or do you want to be able to qualify for more loans? They aren't necessarily the same goal, and they're not going to look the same on your tax return. Just know that if you come to me and say, I'm trying to get a mortgage, I need to show a bunch of income, I'm going to be taking a real hard look. Remember what I said earlier about how I don't have to audit your records? That's only true if I don't have reason to suspect your records are garbage. So if you come to me and say, I had $150,000 in income and I only had $2,000 in expenses, and then you say to me, yep, and then I need to send my tax return to my mortgage lady, we're probably going to be having some pretty hard conversations about whether that $2,000 in expenses is actually accurate or not. So it can affect your ability to borrow. But I, as your tax professional, can't condone lying on your taxes. I won't do it. Maybe somebody else will. Mo Money will do it. But they're also out of business now. So when you get audited, they're not going to be there for you.
Mo money, mo money.
It was like, I think they were in Norfolk. I don't know.
That was 5
It
years
was a
ago.
whole entire thing. Yeah. Any other questions? We can like skip. I mean, I could go, look, y'all, the slides, they just go on and on. I promise to get nerdy with you. Like,
Some things bad. I don't know how if you were going to talk about this or not, but
bring it.
specifically regarding short-term rentals, probably already know a lot of the cities around here have particular restrictions on where you can put a short-term rental. Okay, so you got to consider that. If you're like, oh, I found this great place, I'm gonna buy it, I'm gonna turn it into a short-term rental. Before you do that, okay, do a little research, talk to an attorney, or we don't do approval for short-term rentals, so we don't have a lot of familiarity. I don't know if Chris has, if your firm does it or not. Reach out to him and he can do a little more investigation for you. I know like Virginia Beach, like a resort area, it's like impossible. Norfolk's a little more lenient, but you want to know that in advance before you buy the property. Then you find out, oops, spend all that money. An additional thing is when you're buying property, it's subject to like an HOA or it's a condo association. You got to know those condo docs because they could have restrictions on what percentage of units can be rented out. So they might say, we've already reached that threshold. You buy this property, you can't rent it out, and then you're stuck with it. So condo docs is a whole other, conversation we can have, but that's something to definitely take into consideration.
Yes. And that's why I think I mentioned earlier, this area is not so great for it. That's why my short-term rentals in Gulf Shores, Alabama, they love short-term rentals. Mine is not non-passive because I live 13 hours away and I have a full-time job and I can't get there very often and I can't do my own repairs. I have a property manager. One thing I want to talk about real quick is the gotchas, right? Like the short-term rental thing sounds amazing. Why isn't everybody doing this? Well, there are some gotchas. Depreciation, I mentioned, of short-term rentals is over 39 years, not 27 and a half like long-term rentals. That's why that cost segregation is great, because if you don't have to wait 39 years to recoup all your money. The other big thing is too much use of your short-term rental can reduce your tax benefit. So let's go back to my Gulf Shores rental. I'm a big fan of buying where I vacation. I plan to have short-term rentals all over the place. I want them in the mountains. I want them at the beach. I want them in California. Not California. Everywhere but California. I'm a big fan of buying where I vacation, but you have to be careful how much you use it personally or you don't get the full tax benefit. So there are some rules around that. There are some number of days. Again, I can share this slideshow with Ashley so that she can share it with you all so you can kind of look at the particulars. But just know that if you have a short-term rental that's in a resort area and you plan to use it yourself, you got to count how many days. You got to stay under a certain number of days compared with how many days it's rented out. Otherwise, you lose some of the tax benefit. And you don't want to do that. We talked briefly about short-term rentals, whether they belong on Schedule E or Schedule C. Schedule C is like any other. Schedule C is if you're a real estate agent and you get a 1099, right? You're reporting on a Schedule C. If you're a real estate agent and you've had a Schedule C, you know what self-employment tax is because it's a big old tax bill that you get on top of your regular tax. It's 15.3% on top of your income tax. If you don't have to subject your short-term rental income to self-employment tax, why would you if you don't have to? Why pay 15.3% tax on money you don't have to pay that? So if your current tax pro tries to tell you that short-term rentals automatically go on Schedule C because it's less than 7 days, and y'all, I am in Facebook groups that are for tax professionals, and I see posts all the time where people say, it's less than 7 days, so it goes on Schedule C. These are tax professionals. These are CPAs and EAs. If your tax pro tells you that short-term rentals belong on Schedule C, don't walk, run, like really, really fast, out the door, down the street. There's a bunch of code sections, a couple of, if you can't sleep tonight, some tax court cases. It's super scintillating stuff. The short-term rental loophole, which I'm going to call it a loophole. Most loophole is not a technical tax term. This isn't a loophole. This is straight up in the tax code. But we're going to call it short-term loophole because that's what gets TikTok clicks. That's an IRS Pub 925. If you feel sassy, Google up Pub 925, read about short-term rentals. It's probably going to be in language that's less friendly than the language I used, but it's there. Now, this one is some good reading. Remember we talked about that contemporaneous time log? There are things that the IRS is going to look for if you're writing off very large short-term rental, non-passive losses. It's all in their exam techniques guide. It's literally a guidebook that tells you what the IRS is going to look for. All you have to do is go to the guidebook and have that documentation ready, and you're going to be okay. So check out that link. That's a good one. Maybe after a lot of coffee, not right before bed.
You keep talking about how we're going to take losses on short-term rentals. Why are we buying short-term rentals to take losses?
Remember what I
I
said?
know, because you're going to lower your tax bill. Like, we're only going to take a loss for the first year, right?
No, because you're going to get depreciation every year. It is possible for rental properties to show a gain, right? Like I had a guy, he has a house in Norfolk. In 2021, his short-term, his Airbnb income was $112,000 on a freaking house in Norfolk. Like on the bay, like at the bay. $112,000, y'all. I have never seen anything like it. Obviously, there's no magic I can work to eliminate $112,000. It wasn't his first year owning the house. There was no cost seg study. Like he had a gain on his taxes. There's no way around it. Short of extenuating circumstances like that, it is possible for the property to cash flow positively, but still show a tax loss because you're writing off mortgage interest, you're writing off real estate taxes, you're writing off all the cleaning and maintenance, the repairs, but you're also writing off depreciation. So even in a year where there's no cost seg study,
Like, it's going to take away from your cash flow. Everything but the depreciation takes away from the cash flow.
right, but depreciation doesn't. Depreciation
How
isn't
much
cash
do you
out.
depreciate, like, the first year you do this accelerated depreciation with the segregated costs and whatnot. Can you do that in the second year?
No, so you're not going to get a huge deduction the second year. You're going to get whatever's left divided by 39 years.
Okay.
But I'll go back to my rental in Alabama. It's seasonal. So I'm renting that thing from April through October, but I'm paying bills on that thing year round. So it doesn't, I show a tax loss, even though I can't write it off because it's passive for me. But even without bonus depreciation, even without a cost seg study, it's still showing a loss on taxes because the income in 6 months doesn't cover all of my expenses for the whole year.
Yeah, but you are losing money.
It's like breaking
That's why I
even.
was thinking, like,
So
sure.
my cash, we're breaking even.
You're breaking even.
But then I get my depreciation deduction, which puts it into a loss position on my taxes. So depreciation is not cash you're paying to anybody. It's a tax construct. Yeah. So it may not generate a huge loss after that first year, but it's still a loss. And if you're in a place where you can consider it non-passive, that's going to be a benefit you get to take year after year. But eventually, right, like we all get into this because we want them to cash flow. But depreciation is usually the thing that'll put it over. Unless it's making a whole bunch of money, right? Like if you have a rental in, I don't know, Vail, right? But like I have a studio size condo, like that thing isn't renting for hundreds of dollars a night. It's like $199 even during peak season. This year might be different. I actually have a tenant, one person who's renting it from November 1st through February 28th. I'm really excited. But now I'm going to run afoul of these average use 7 days or less, average use 30 days or less, and substantial services. So now, like that one rental could move my property from being a short-term rental to a long-term rental or a mid-term rental. Whole other topic. But the amount of tax benefit from depreciation can vary, right? Like if you have a property that rents really well, you may not ever have a loss. You may be showing a gain every year. That's when it's really important to make sure your tax person knows that it doesn't go on Schedule C. Because if you show, let's say, $10,000 of net income, if they misreport it and put it on a Schedule C, you're going to be paying 15.3% on that $10,000 on top of income tax. Right. Then your 1099 income goes on Schedule C, but your rental income shouldn't. Mm-hmm. So that like your $100,000 you made as a real estate agent, sure, that's going to be Schedule C. We would want to talk about S Corp. That's another conversation, but you're going to pay self-employment tax on that. But that $10,000 from your short-term rental, you don't have to pay 15.3% tax on that. It doesn't belong on a C. It belongs on an E. Yeah. Never, ever, 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 ever. And there's very little in tax where I'm going to say never, never, or always, always. Never, ever, 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 ever own appreciating property in an S corporation. So if you're LLC, if all you do is own rental properties, whether short-term or long-term, S corporation is never going to be your jam. You don't ever want to do that. If you're a real estate agent or You have wholesaling income, right? You have other Schedule C income that's not owning rental properties. And this isn't flips. Flips are different. We'll talk about that in a second. But if you own buy and holds, never put those in an S corp. That could be a whole other session explaining why, but never put those in an S corporation. You can have them in an LLC. You can have them in a multi-member LLC that's taxed as a partnership, but never in an S corporation. Now, flips are different. Flips are treated like inventory. You buy and sell flips, that's like you buy and sell widgets. I bought, dingle hoppers and sold them on eBay. Flip houses are dingle hoppers. That's a great example of a business that could be in an S corporation because y'all ain't seen Little Mermaid? Come on.
Haven't you ever seen Little Mermaid? What is wrong with you?
It's been like 35 years.
Thank you. I almost started singing it, so thank you for saving us all. That would not be good. Widgets. So we're not rental, like flips are widgets. Flip houses, the income generated from flipping a house is ordinary income, just as if you were a handyman, just as if you're a real estate agent, just as if those can go in an S corp. That's ordinary income anyway. You're good to go. But buy and holds, whether short term or long term or mid term, that's a whole other conversation. Never in an S corp. The problem isn't while you own it. The problem is when you try to sell it or if you die. Remember that step up in basis we talked about? If I own my house personally, my rental, or in a single member LLC, step up in basis. If the S corporation owns the house and you die, nobody cares. You didn't own the house. Now, there may be a step up in basis for the stock in your S corp, but that's a whole other tax topic. So no rental properties if you take nothing away from tonight other than everything Ryan said. But from a tax perspective, never buy and holds in an S corp. If your tax person says, let's make your business an S corporation, don't walk, run. No Schedule C, no S corps. Who's got questions? Yeah. That. I'm gonna let Ryan take this one. So the question was, wills versus trust, is there a better route as it pertains to your real estate? That is definitely not my area of expertise.
So it really depends.
Told you.
Wills are a little more simpler. It basically just says when I die, this is where I want my stuff to go. Okay. Trust is something that you create. It's kind of like a company that you create and it's effective immediately upon your creation, drafting the trust documents. Okay, and you can put assets in the trust, so you can put real estate in the trust, just title it in the trust owns it. And the trust is kind of like the operating agreement, as we discussed earlier. The trust document dictates how the trust is run, who's a trustee, what happens when the beneficiary of the trustee passes, okay, successor trustee, what do they do with the property? So it's great for estate planning because you can put in there, okay, when I'm the beneficiary, it's the Ryan Ramstead Trust. When I die, and I'm like, I want the trustee to sell all my property off and give it to just divide it evenly amongst my children. So the trust is created now. The trust is funded now by assets. The trust owns the real estate. The trust is responsible for tax side of things. The trust can buy or sell. Okay. So typically we do a revocable trust, which means that you create it, you can put stuff in and out of the trust. Okay. Trust is good because it can bypass probate. So when I pass, it's not as if we have talked about earlier, you have to go to the probate department and they have to record the will and everything, okay, to make it official. It's like, no, the trust already owns it. It doesn't really matter that I'm dead, okay? So the successor trustee will come and play and they'll do whatever needs to be done with the property. Does it make sense?
Sure, answer your question. It's more expensive on the front end, but it is way less egg on the back.
But let me tell you
Yeah.
real quick to kind of piggyback on one thing that Ryan said is you have to fund the trust, which means you have to actually move the rental property into the trust. I can't tell you how many times I've seen people create the trust and then not actually deed the properties to the trust. You got to do that step. Otherwise, it's no good. The trust owns nothing.
Yeah, so you could deed property into your trust. You're not gonna be paying any taxes on that. Any taxes you typically get, transfer taxes if you're buying or selling, but there could be definitely a tax implication on that side. And so typically, I'm not qualified to talk about that, so I refer to people like her.
I don't do trusts. So
some
I'll
people that
refer you to
not
somebody
like
who
her,
does.
You need to
Yeah.
talk to. But there can be a tax implication of essentially getting a gift, doing a no considerations being passed. Essentially, you're just giving it. So again, I wish I could talk more about that, but that's something I really just can't. I mean, it's the same issue. Bless you. When you're talking about when you're gifting property to somebody, or you're putting something into an LLC, there could definitely be some tax implications that. Can you talk about the LLC?
Yeah, there's not, well, in Virginia. So some states are different. Like we're not going to talk about California and New York because they make everything tax related difficult. But in Virginia, you can deed your property to the LLC. You can take it back out. You can drop and swap. You can do all these. You're going to take it out to refi it, put it back in. You can do all that. And there's not really going to be any tax implications as long as it's a single member LLC. If you formed an LLC with your spouse, your brother, your sister, your mother, your uncle, your best friend, different conversation. It's a partnership and there could be tax implications. But if it's a single member LLC, as far as the IRS is concerned, that's a disregarded entity. The IRS does not view the LLC as an entity separate from yourself. It's a legal construct, not a tax construct. So pot, poker game, do whatever you want with it.
Yeah.
Some states have different.
But it's really easy to title transfer into.
You just got to actually do it,
Trust.
right? You just got to actually do it. That step is very important.
There's also the anonymity. There's this behind the closed door. So you're anything like the open company like us, we go out, we strictly comment broker. We pull the records, find the people that are the heirs, we find the administrators, the executors, we contact them. If you're inside of a trust, none of that happens. It's not public record, right? That's another.
Yeah, it's not public record.
I'm glad I was muted on that one.
But we need to wrap it up for the live stream, and then anyone who's here can still ask questions. So Sean, if you could sign us off.
How about now? Can y'all hear me over there? Okay. So I want to say thank you to you guys for both coming out. Thank you. Round of applause, please.
Thank you.
So really good information. Let's hang out a little bit, network, talk, right? For those guys online, obviously you can't see us, but thank you so much. We had a pretty good showing tonight, smaller group, but I like it when it's smaller because you can get more questions answered and it's a little more intimate. Thank you so much for taking the time to be here. I really appreciate it. You guys are a huge wealth of knowledge. I always tell guys everybody knows this, right? Your network is your net worth, like that whole saying. That's very true. I just over the past few years realized it's not about what you know, it's who you know, right? Go to the right people, put the right ass in the right seat. That's what it's all about, right? You can't do all this by yourself. So thank you so much for taking the time to be out here and taking the time to put this thing together and share the information. I really appreciate it.
Thank you.
Thanks for having us.
Awesome. So guys, let's hang out for a little bit. We've only got a few more minutes before they close out and close down.